Hi guys, welcome back to Father and Son Investing. Today we're going to be talking about I-bonds. We'll talk about what they are, and this video will discuss what the advantages of I-bonds are. At the end of this video, you'll have a link to the disadvantages for I-bonds as well. So let's get started. So just what is an I-bond? It's a savings bond issued by the United States government that earns interest based on combining a fixed rate as well as an inflation rate. We take those two together and we will call those the combined rate. Now currently the combined rate is 9.62%, which is why a lot of people are very interested in I-bonds right now. That sounds fantastic. In fact, it is fantastic, 9.62%. In the disadvantages video, we'll talk about why that might not be so great. Now you can buy your I-bonds directly from the treasury.gov website. In fact, this is what the website looks like. Now just some general things about I-bonds. First of all, you can buy up to $10,000 of I-bonds per Social Security number per calendar year. So if a couple is married, they could get $20,000 worth of I-bonds between the two of them per calendar year. You need to know that these I-bonds are taxable by the federal government, but not taxable by state and local governments. And they are sold in denominations as small as $25. Now you may be wondering, how does an I-bond earn interest? Well, that interest is given each month, and then semi-annually the interest is compounded. So that each 6 months, the interest that has been accumulated during that 6 months is added to the value of the bond, and then that interest will earn interest. So just what are some of the advantages of purchasing I-bonds? Well, first of all, the inflation protected part of this. It is tied to the consumer price index for all urban consumers, commonly known as the CPI-U. That rate is going to be calculated every 6 months based upon the change in the CPI-U from March of one calendar year to September of the same year. And then for the following year, it will be calculated from September to March. So we can get an example of this from the treasurydirect.gov website. We'll see that in May of 2022, the inflation rate for 6 months was 4.81%. So if you want the annual rate, you're going to be doubling that, and thus we get 9.62%. We can also go back in time and look to see what the rates have been in the past. If we go back to last November, we'll see that it was 3.56% for 6 months. Again, you would just double that to get the annual rate. You'll notice here that these rates have really just gotten quite high within the last year, but if you otherwise go back, we're looking at 1.77% for 6 months, so a little bit more than 3% for the year in May of 2021. If we go back even farther, we can see that back in May of 2016, it was 0.08%, so doubling that would get you 0.16% for the year. Nevertheless, the fact that this bond is tied to the inflation rate is a hedge against inflation, because at least the principal value of that bond will theoretically remain the same for the life of the bond. I say theoretically because, again, remember that these bonds are taxable by the United States government, and thus you could end up paying tax on your interest depending on what your tax rate is. Now, another advantage of the I-bond is just simply how easy it is to purchase them. You can buy them directly from treasurydirect.gov on their website, or you can actually enroll in a payroll savings plan through your employer and have money go directly from your paycheck to purchasing bonds. What's another advantage of these I-bonds? They're quite easy to give as gifts. You can purchase paper bonds. If you want to get paper bonds, you're going to have to purchase those when you send in your tax return for the year. But you can also give these as electronic bonds as gifts. Let's just talk about one more advantage of the series I-bond, and that's when it comes to education planning. And that is because the I-bond, in certain circumstances, can be exempt from federal taxes if it is used to pay for higher education. Now I say in certain circumstances because you need to pay attention to the rules here. For instance, you need to be 24 years or older when your savings bond was issued. If a person is less than 24, then that bond will not be exempt from the tax, regardless of how old they are when they redeem the bond. What else do you need to know? Well, you can pretty much use them for any tax filing status except for married filing separately. And the other big thing that you need to know is that if you purchase these for a child, which is possible to do as a parent, If the child is less than 24 when you purchase them, then the bond can't be used for either the parent or the child for education expenses, so you need to keep that in mind. Lastly, you need to pay attention to this form, Form 8815, Exclusion of Interest from Series EE and I-US Savings Bonds issued after 1989. This one was for tax year 2021, but if we scroll down here, it's going to start giving you some idea of what it's going to take to qualify. Pay special attention to line number 9. Note, if line 9 is $98,200 or more, this is your modified adjusted gross income we're talking about. If it's $98,200 or more if you're single, head of household, or a qualifying widow or widower, or more than $154,800 if you're married filing jointly, stop. You cannot take the exclusion. So just keep that in mind. Lastly, let's just talk about two other advantages of the Series I bond. One is that the price never changes. There are bonds that vary in price depending on what the future value of the bond will be. In this case, the price is set. If you purchase a $25 bond, the price is $25. If you always want to purchase a $25 bond, the price will always be $25. Just know that the value of your bond will change over time as that interest accumulates. What's the other advantage of this type of bond? That is that you can never lose money from this Series I bond. What do I mean? If interest rates go negative, they don't start subtracting money out of your bond. The principal value of your bond will always be there, and all of the interest that has accumulated will always be there. Now, there are two important caveats to know when I say that value will always be there. The first one is that you have to hold the bond for at least 1 year. You're not going to be able to redeem it for at least 12 months after you purchase it. And the second thing to know is that if you hold it for less than 5 years, they're going to charge you an interest rate penalty. That penalty is just the last 3 months of interest on your bond before you redeemed it, should you redeem it before those 5 years are up. All right, so in this video, we've talked about some of the advantages of the Series I bond. Very simple to understand, very simple to purchase. You can buy them in really small denominations as low as $25. Easy to give as gifts, both as paper. Remember, if you're going to use paper bonds or buy paper bonds, so you're going to have to do that when you file your tax return. And easy to give as an electronic certificate as well. The price of the bond doesn't change with interest rate changes, and the composite interest rate will never be negative. By composite, we're talking about that combined interest rate. I hope this was helpful for you. If it was, give us a thumbs up, and don't forget to click on the next video about some of the disadvantages of I bonds.